Welcome back to another episode of the Retire While You Work podcast. I'm Miles Zuger, joined by Carson Odom and Jerry Ann Agee. Happy to be back with everybody here, both of you and all of our listeners out there.
Riding on the
all five
coattails
of
of
them.
the women's U.S. hockey team winning gold. Shout out to the USA women.
Yep. And we got another big game today.
Cool things. It was very exciting to watch.
Mm-hmm.
Of course, we were working hard. Just had it on in the background.
Absolutely. Yeah.
Just in the background.
The hockey game yesterday, literally, I looked away for 1 second, I feel like, and I looked back and I was like, oh, it's over. Like they were all like congratulating each other and everything. It was
we have
crazy.
couple TVs upstairs. Bryce's TV was probably like 10 seconds ahead of the one Carson and I had.
Oh, wow. Yeah.
And he like said something. He was like, "Oh, did you guys see that?" And then like he ran over, and then they were like rescoring the goal. But like it was live for the first time we'd seen it. So it was kind of funny.
Also, it's Friday. We never record these on Friday, so that's fun. We're all in better moods. I'm kidding. No, we're fine.
There was let's see. Quite a bit of gold medals. Last standings I saw it, the USA was in second behind Norway with gold medals and total medals, something like that. But I don't know if there's any catching up to a Scandinavian.
Those Norway skiers, they are built
Winter
different.
Olympics.
I mean, they must have to do that on their way to work or something. They're literally built different.
I was looking at, I think the first Winter Olympics was in 1924. So I'm kind of surprised they didn't make a big deal about 100 years plus of the Olympics this year.
Yeah, true.
I mean, I know it was a couple more, but all that to say, Norway is like the history of the Winter Olympics. They have the most medals of anybody. I feel like the U.S. usually has more for summer, by a lot.
True.
Like we kind of always win, but I guess typical American assumed that was the same for the Winter Olympics also, but it was not. They're like leading from the outset, like most.
Yeah,
that's interesting.
Okay, so what
Let's
do we got on the
it.
agenda for today?
I think what we wanted to focus on today, we get kind of some different questions from clients in general, whether it be over email, in-person inquiries, after listening to our podcast. And we have 4 or 5 of the most common questions that we wanted to bring up today and just kind of roll through a Q&A sort of, just so that we can address these questions since they are the most commonly asked and the most applicable, we feel like, especially right now too. So we're going to do a little Q&A. We'll keep it short today.
I feel like we found if it's on one client's mind, it's usually on at least a few others. So I think good.
For sure.
Just run through some of the more common ones. And these are ones we've gotten multiple times. So just run through them for people.
So the first one's a good one. Well, they're all good, but they're all timely. With interest rates now being lower, what should I do with my cash? That's a big question we get. Carson?
That's a tough one. My opinion is kind of twofold. So if we're talking emergency fund and cash in the bank, that's truly acting as an emergency fund, no impact. Interest rates don't necessarily have an impact on your cash that's acting as an emergency fund. Always look to make sure you're maximizing it and getting the best interest rate that you can. But just because interest rates start to go down, that doesn't necessarily mean you should have less of an emergency fund. What should dictate your emergency fund is how many months worth of expenses are in the bank account. Now, on the other side of that, we could argue, is cash a asset class? Like, should it be a core part of your portfolio? I think there are better asset classes to act as a conservative, high-yielding investment, some different bond sectors. But if you find yourself having a large sleeve of cash and you're trying to work it down, we're actually going to get into it in one of these other questions. But I think getting into a more productive asset for sure.
Yeah, and I agree with all that. And I think I would add on to that, maybe just evaluate monthly cash flow as part of this also. Like if you see from a month-to-month perspective, you see cash being added to that savings account or that emergency fund each month, whether it's $500 or $1,000 or even more than that, come with a plan to start working some of that into your investment portfolio so that it's not just sitting there in cash building up, not being very productive. Get it streamlined so that you're contributing to make sure, of course, to your 401k, but also if you're putting enough in there, also into just an investment account that's liquid outside of the emergency fund and can serve as an extension of that emergency fund in dire situations.
Yeah, I think that's good. If you're kind of examine what interest rate you're getting, yes, and you should absolutely be maximizing your savings account. And if they're paying you, in your emergency fund of 50 grand or 100 grand, and they're paying you 2 pennies a year, absolutely look and get survey that out. It's not going to make or break your financial plan, but you might as well be banking a few $1,000s on your savings as opposed to just sitting making nothing.
Sometimes the first best step can just be to ask your bank, like,
Yeah,
hey, these
for
other banks
sure.
are paying me, are willing to pay this much. Why are you guys not? Or can you come up the middle? And you may just decide you don't want the hassle of having your cash right everywhere, so you're willing to take a little bit less to keep it all streamlined.
For sure. There's a
I think
convenience
it's
factor
again,
there.
it's not the cash is not the get rich bucket. It's the
Right.
stability, emergency fund, upcoming expenses place to have
Right.
cash. So optimize it as much as you can, but it doesn't need to be perfect.
Yep.
Okay, let's see what else we got. Markets feel expensive right now. Should I wait before investing new cash? Miles, what do you think on that?
The data here, or
And I feel like there's a bunch of charts you can
emotions?
pull up for this
Yeah.
one. I think this is one whenever the market's sitting at all-time highs, which I think it's important to note that the market is more frequently at all-time highs than all-time lows. I don't have the exact number in front of me, but I think like on average, the market's making an all-time high like every couple weeks, essentially, if you look back at all-time highs over the history of the market. So, it's always kind of hanging up around these higher levels. Obviously, when you see corrections, that's time to, make sure you're diversified, add cash at that point. But all the history and the stats show that even if the market's up at a higher level, you are better off over longer periods of time, longer being 1, 3, 5, 10 plus years, getting that cash to work at that time. Now, if you were to time it perfectly, like at a low point in the market, of course you end up better off than at times putting it to work at a high point. But the one thing that is for sure is that you're far better off than just leaving it in cash, making 2, 3, 4% over longer periods of time. I actually saw a chart within the last couple of days illustrating that perfectly. It was like, time it on the best day, and you end up with a little bit more. I think the difference over a 10-year period of time, if you were to get $100,000 of cash to work, was like, a few $1,000s. But compared to cash, it was like tens of thousands of dollars that you were off. So, we always kind of say the best time to get cash to work is when you have it. And then supplement that with some sort of monthly dollar cost averaging going in also, just to have that momentum going. And then, of course, if it's cash you're going to be needing in the next 6 to 12 months, like maybe you don't get that to work at a high point. But if it's cash you don't need for the next 3, 4, 5 years, I think it makes sense to get it to work.
Yeah, just to echo a little bit, I would just say we know that historically the market has never failed to make new all-time highs. And if we believe in our society in general, we know that a dollar today, we know that we invest in publicly traded companies because they're going to be more valuable a long time from now. If that's fundamentally true, then you would say, why would I wait to get my money invested? Why not? Why wouldn't I invest it as soon as possible to capture as much return as possible? Now, that doesn't take away the emotion that it could be a bad time and the market could start falling the day after you end up investing your cash. That's why I think at a minimum, invest some now. And then if you have to, from an emotional sake, dollar cost average, but not over a 5-year period, do it over a handful of months. Like give yourself a certain time that, okay, by the end of, it's February now, by the end of May, I'm going to be fully invested. So let's make sure I'm fully invested by the end of May, just so that if there are any dips, you can take advantage of them.
And that helps take the timing game out of it.
Yes.
Yeah.
Yep.
And a lot of people, just to throw this out there, they think that to get into the market, they need to have a whole big bunch of money to make that happen for it to grow. But if you're doing it, like y'all said, every month, just a little bit at a time too, that can make a huge difference over the long run. So the market, as you said, just keeps going up. So that's only gonna help. And even if there's a down year, I mean, that it's or a down month even these days. It seems like that's all it's taking to correct itself, but it's never a bad time, I don't think, to get in.
I'd agree with that. And I think when you actually look at the numbers, especially younger, maybe people who have not invested before are very surprised at what a smaller amount. I mean, even 50, $100 can turn into, you know, 25 years from now.
Yeah, Peyton sent me a text just this morning. One of her best friends from college has a really great job, and she's doing really well and knows nothing about finances. And Peyton said, "Mom, she has 300,000 sitting in her checking account. She doesn't know what to do." And I was like, "Just tell her to call us."
Dang,
So I
yeah.
was like, "Yeah, I mean, that's like crazy in our minds that to do that, but she doesn't know any better, I guess. And kudos for her for saving up that much."
At least you didn't spend it.
I know, I know, I know. Okay, let's see. Here's the next one. This is a good one, especially around here in Nashville. But with mortgage rates still elevated, is buying a home right now a mistake? Who wants to take that one?
I can throw a first comment out. I don't think if you can afford it, no, regardless of mortgage rates. We say the question is, with mortgage rates still elevated, is buying a home right now still a mistake? Keep in mind, mortgage rates are right in their long-term trend. Like this, we're in a very average mortgage rate environment. The day and age of having a 2% interest rate on a mortgage, I would say that's more than likely to never happen again. If anything, I think you have a higher chance that rates are going to be higher as opposed to getting a 2% interest rate again. So it's all relative. We all have recency bias with hearing about the 3% mortgages from 3-4 years ago. So I think if you can afford it, based on the interest rate you're getting now, and you want to purchase a home and it works into your monthly budget, you find a great property, buy it. Buy it if that's what's best for you and your family. But don't get too caught up in a high mortgage rate, because chances are you're not going to see a 3% mortgage rate again.
Right. And it could even, I'm sorry, Miles, real quick, but it could, they could go down slightly still. But even then, if you're looking at what you could afford back at a 3% versus what you can afford at a 5.5 or 6%, it's a whole different ball game. So
Yeah, that's what I was going to say. I mean, with where they're at, you can always refinance to a lower rate if they do come down. So if you can afford it at, ballpark at 6.5 right now, if rates drop to 6 or 5.5, you can obviously afford it at that rate also. And the one thing that I've heard before, and I think it rings true, is people don't buy houses for what the house actually costs. They buy houses for the payment that they can afford. So there probably is a lot of people who the house that they bought on a 3 or a 3.5% mortgage probably could not afford that house today at a 6.5% or 6%, wherever
right.
they're at today. So
Definitely. Yeah.
yeah. So I mean, if you can, it's more about what is the payment that fits into your budget and lifestyle, and of course that you like the house for that range. I don't think it's so much to what the actual rate is, because if they come down, you can always refinance out of it.
Yeah, I mean, that's really the first thing you need to do if you're actually looking to buy a house is get online, get a calculator or whatever, and find out how much you can afford and base it on that payment. So, okay, let's see. Oh, here's a good one that we get asked, or people kind of assume this. With Social Security uncertainty always in the news, should I plan as if it won't be there?
Do you feel like this is one of the more I feel like we've gotten even over the last few years. I'll speak for kind of all of us. I think when we're building financial plans, we are still factoring it in. When they
For
talk about
those
it,
who are close to Social Security
yes.
age at a minimum, yes.
Yeah.
Yes. When they talk about it going away, it's not like it's going from whatever you're supposed to get to $0. I think it's, in the mid 2030s, going to get cut to like 70% of what you were supposed to get at full retirement age. So it's not going to zero under current rules. But I also think one of the reasons we still plan for it, especially for those who are closer in age to taking it, is I think there's very small changes that can be done to keep Social Security going. The biggest one being, people being born today or born within the last 20 years that are probably going to live well into their 90s or beyond have the same ability to start it as somebody turning 62 today. I think the easiest thing they can do is say, hey, if you were born, and they'll just pick a day. If you were born after 1980, you can't start it until you're age 70 or something like that. Whereas now that person can assume they start at age 62. That kind of re-rates like the whole amortization schedule, people pulling from it. And like that alone extends it out. Right now there's also the income threshold. So if you make up to like $170,000-ish, like if you go over that amount, you actually stop paying Social Security tax. So they could say, hey, there's no cap on Social Security earnings, and people are like paying it even on higher amounts of income. That also adds more money to the pot of pool that Social Security is being paid from. And then, I mean, they can also raise, Social Security taxes on people, and then there's a little bit more money go to that pool. Also, I think the biggest thing is that something will
Miles,
be done.
why don't they just put you in charge of it?
Those
are all good
I just got a
points.
couple ideas. The other one, I've actually seen this before too, is it's only ever been in like the pool of money that's used for Social Security has only ever been invested in treasury bonds. Whereas if they had just managed it like a 60-40 portfolio, there's like trillions of dollars in this fund, and it's so well funded that there's like zero chance of it ever running out of money. I mean, I guess you can't say zero, but it's a high likelihood it would never run out of money because there's so much extra money in it because they actually own stocks and things like that. I doubt they'll ever do that, but I think a change will all that to say, I think a change will be made because it just has to be. There's way too many people that rely on Social Security. I forget what the stat is, but it's like
the stat is it was a lot, and
it's over half of it's like 60-70% of people who are on Social Security have zero assets to their name. So it's not, if you're on Social Security, no, I don't think there's any impact that's going to come in your lifetime. If you're close to claiming Social Security, I'm of the opinion that you're more than likely not going to have your benefit impacted. If you are in your 30s and below, I think there could be an impact where maybe your benefit is lessened, maybe your tax on your income right now is heightened, or maybe your age that you can claim Social Security is pushed back to like 75 years old instead of 67. So
because the other people would start it at age 62 and they'd live to like age, like their late 60s. They were on it for like 5, 6, 7 years. Now people are, can start at age 62 and they're living in
30 plus
20,
years.
30 years. So the draw is just much more than it was ever kind of designed.
Yeah, initially, when it came out, life expectancy was shorter than the age that you could claim Social Security. So it's if you happen to live longer than you're supposed to, here's a little bit of end of life money. That's how it's designed and operated, and it's just completely different these days.
Yeah. Yep. Okay, good. Let's see. Last question. How do I stay confident in my plan when the news cycle is constantly negative?
Turn it off.
Yep.
Turn it off. Fear sells. You've got to put yourself in the eyes of the of news outlets. What gets clicks and what gets people talking is fear, and that's what they're trying to get clicks, and they're trying to make money. So they're going to publish things about fear. There's always going to be an article about how the next stock market crash is incoming, or how stocks are going to dive, or how a recession is imminent. There's always going to be articles about that. So go back to what you know and the people that you trust. Have people that you can talk to. I think having a group around you, friends, financial advisor that you can talk to about things is one of the best ways to protect yourself from getting caught up in the emotional roller coaster of news.
Yeah. And if you have a good financial planner that you trust, let them be the ones that are keeping up with things that are going on in the economy, the market, whatever, and know that they've got your best interest. If you have a good one, they've got your best interest at heart, and let them take some of that off your plate. You know what I'm saying?
There's always going to be something also. Like there's always going to be a reason the world's crashing, or I mean, there's several charts. We should have prepared a little better, had some charts, but there's several charts that have like the return of the stock market, and it's obviously gone up over time. And then all the events where people said this is the reason that the world's going to come crashing down. And every time to date, historically, the market has continued to go higher. So there's always going to be something, to Carson's point, fear sells. And that's what's always going to be pushed in your faces. And if the more you can ignore that, and kind of the less you can watch the daily fluctuations of your portfolio, and find a cadence that works for you to where it's not stressful and anxiety provoking, the better.
Yeah. I mean, we literally have clients from one extreme to the other. Some that check it every day, multiple times a day, and some that literally don't ever look at it. And we tell them when we meet with them, like how well it's done or what's going on with it.
Yeah, I can remember meeting with some clients. I think it might have been like during maybe 2020 when the market was down. Maybe it was last year when the market was down for a couple months. But we got on the call and they just said, "We haven't looked. We don't." I think it was last year. They said, "We haven't looked. We don't really want to know. Let's just talk high level." And like, I mean,
Yeah.
and obviously they were fine, and now it's up higher from where it was when we had that
Right.
conversation. But
Right.
so
Yeah, I mean, the whole rule of you don't lose money in the stock market if you don't sell. So that's the
It's
truth.
true.
yep.
But yeah, well, that's all I got on questions.
Yeah. I think
Y'all got
feel free
anything
to.
else?
No, I like doing it this style, so we'll have to
Yeah.
maybe do these ones regularly. So feel free to send us your questions, and we can start compiling a list to keep that running. And I think go ahead and share and like our podcast and subscribe. And we're trying to grow this and get a few more listeners. So we appreciate all the support.
See y'all next week.
Thank you.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.